Uh, Once again, this is the Investor Show. Happy Sunday afternoon for everybody that's out there that will tune in and catch this live. Hopefully, you guys can hear me pretty nice and well. I may be looking a little rough, but I am here just to kick it back with you guys. So, as you guys can see, hey, what's going on, J Stay Hip? I'm going to be going through a topic today called 7 ways you can get started in investing. The reason why I'm bringing up this topic, I wanted to do real estate investing trust and stuff like that, but I come to realize that a lot of people who follow this channel, the number one question I'm always asked is, Prince, where do I start? Prince, where do I want to get into investing. I've been watching you. I've seen some of the stuff you say, but where do I start? All these tutorials are great, but where do I start? Where do I go? So I'm going to make this today Prince Talk Live. It's going to be about how to 7 steps to get started investing, right? These are 7 steps that I written in my notes that I'm going to go through. So first, the number one step. So we're going to jump straight into it. The number one step is to first evaluate your debt. How much debt you're in. Now, granted, the average middle class person has some type of debt, and majority of the debt is something like maybe car notes or houses, or maybe you may own some real estate, student loans, all that type of stuff that you may owe, right? So first, credit cards, department store credit cards, all those things like that. Those are the things that you're probably going to evaluate first, right? Now, I understand everybody has some type of debt, but a house, it's a debt. Yes, it is. But majority of us won't pay that off. Middle class people won't pay that off. Student loans, depending on the interest rate. It depends on the interest rate of everything. But I know the most detrimental one is credit cards, store-bought cards, because they usually run up to the interest rate of like 10, 15, 20%. Those things are very hard for you to invest against, because if you know the average stock market averages about 10%, right? That's if you get the S&P 500 average. So you have to evaluate your debt. Do a debt evaluation, because the reason why I want you to evaluate your debt, because first I feel as though you should pay off your debt. Now, granted, I know not everybody's going to pay off a house. Granted, everybody's not going to be able to pay off all of their cars, all of their credit cards, everything. But those high interest credit cards or payday loans or any other type of debt that you got with high interest rates, pay those down first, because it makes it extremely hard to try to go invest when you have that type of debt, and it actually compounds your situation. And what I mean by compounds your situation, it makes your situation worse than what it already is, right? So number one, evaluate your debt. Look at ways you can pay down your debt, get rid of your debt first. The reason why that's important is because if your debt is earning 20%, but you're investing making 10, 12%, you're still spinning wheels. You're not getting anywhere. So the safest and easiest way, pay off the debt. Find ways to get rid of your debt. So not all debt is the same, but evaluate your debt. See if there's some ways you can get rid of those high interest rate things like credit cards or payday loans or anything like that. All right? That's step one. Step two, once you have gotten your debt controllable or paid off, start an emergency savings, right? Because what happened is people are like, man, you know what? I want to invest into cryptocurrencies. I want to invest into the stocks. I want to invest in whatever the case may be. And soon as they hit, the car, your car is a 2002 Nissan or something like that the engine can blow up at any time. So as soon as you run into a car trouble or you run into any type of trouble, the first thing you're going to do is you're going to get rid of your investments. So the first thing you need to do is to, first of all, evaluate your, make sure you have an emergency savings. The rule of thumb is 3 to 6 months of expenses set aside, right? And the reason that is because you don't want to start investing, the market crash, and now you're having a financial situation. You're trying to run in and take out on investments at a bad time because you have an emergency situation. So first, when you get your debt paid off or paid down dramatically, now you want to start an emergency savings account. That's step number two. Number three, Now you want to, if you have a job and you have a qualified 401k plan, evaluate your 401k plan. See on your 401k plans ways you can invest. The reason why I'm going to point you to your 401k because of the fees are extremely low. You have tax breaks, especially if you can make it a Roth IRA, depending on your income level, depending on your income level in the future, depending on what your picture is. If you inbox me or something like that, I can give you my personal opinion. I'm not going to advise anybody what to do, anything like that. But look at your 401k. Evaluate your 401k. Look at it some ways. Are you contributing to your 401k? Can you build into your 401k? The reason why I'm going to say look at your 401k because of the tax advantages that it has, and sometimes it has low fees. But not all 401k plans are the same, right? Let me read a question real quick. Agree, investments are not savings. Exactly, right? Let's see, what else Jay stayed here. I wish I put into my 401k and my job, it matched. You got a dollar for dollar match, and you didn't. Wow, that's another big one. A lot of 401k plans match you dollar for dollar, right? By me being active duty military, we don't have a matching plan currently. It's for the newer people. I'm on the later end of my career when I'm getting ready to retire in 5 years. But for the younger people, they don't have, they're getting a matching plan up to like 5%. But that's another thing. Your job, if you look into your 401k plan, every dollar that you put in, they may match you. You take that money, put it into the S&P 500 inside of your 401k plan. So that's the third thing you need to do. Number 4, outside of your 401k, let's say, hey, you have your 401k plan, but you still want to kind of do your own thing. The number one way to be able to purchase your own stock is to be able to, you got to start a brokerage account, whether it's E-Trade, TD Ameritrade. I know Scott's Trade just brought TD Ameritrade, but you have Charles Schwab, you have Fidelity, you have so many online brokers out there. You must pick one and start a brokerage account. I have videos directly on E-Trade and TD Ameritrade since I know they're the most popular. So first you must start a brokerage account. That's step number 4. Start a brokerage account. Open up a brokerage account. I have step-by-step videos to show you how to do that. Number 5, once you have a brokerage account, congratulations, good on you. But now you must fund the brokerage account, meaning you must put money inside of your brokerage account, right? Once you put money inside of your brokerage account, this is how you can figure out what you want to buy. Because having a brokerage is like opening up a checking and savings account. Great. You just can't open a checking account, take a card, and go start charging. No, you must fund it some type of way. Same thing with a brokerage account. You must fund it, right? Number 6, once you transfer your money in, now you have money inside of a brokerage account, you must decide what is your risk level. Are you high risk, low risk, moderate risk, right? High risk, if you're usually going to go by your age. If you're a younger person, if you're in your 20s and 30s, you can sustain risk, meaning that if the market crashes tomorrow, it'll probably work in your benefit. You're going to go, you have time to rebound from different hits and things like that. Now, number 7, decide your longevity. How long are you a short-term or are you a long-term investor, right? If you are depending if you're high risk and long-term, now you may look more into equities, right? Equities means like things that are in the stock market. So if you are short-term, you may look into a technology stock. You may look into a cryptocurrency, something that can rise very fast, right? Depending on your risk level, if you're high risk, if you're low risk, or you're moderate risk, and depending on if you're short-term or long-term. Those are ways that you can look into. Those are 7 steps that you can get into investing, right? The first step, look at your debt, evaluate your debt, because you don't want to be spinning wheels. You don't want your investments making money, but your debt is making twice as much on interest, right? The second thing, save up, get you an emergency account. Once you have your money saved, now if you have a job, you have a qualified 401k plan, evaluate your 401k plan, because your 401k plan can, due to low fees and just what I think what Jay State Hip just said, you may have a great matching program. You may have, some jobs have stock options, things like that. Great ways that you can invest that could be a benefit of you being a part of a particular company, right? I'm a firm believer if you work for a Fortune 500 company, you should have a portion of the company, maybe some type of stock options, right? So number 4, a brokerage account. Now you must If you decide outside of that, you decide, hey, I want to be able to buy my own individual stocks. I want to be able to do whatever the case may be. You can go start a Roth IRA depending on your particular income level, right? Number where was that? Yeah, number 4. Open. I did say that 4. Open up a brokerage account. Number 5, transfer money in. 6, decide your risk level. 7, decide if you're going to be short term or long term. And those are the things you should look into investing in, right? If you're someone who's very short term, you may look into equities, or you may look into some ETFs or mutual funds. There are all type of tools out there for you, right? So hopefully that helps you. To anybody that asks me the question that inbox me all the time, Prince, I want to get into investing. How should I start investing? Now, also, I want to go back to step number 3, your 401k plan. Once you have your 401k plan, you have to evaluate the tax benefits, traditional or Roth IRA, right? I would advise you to get with a CPA, someone who can better guide you on that, depending on your financial picture and things like that. What works for me better is my Roth IRA, meaning that I pay my taxes now. I pay my taxes now because I'm in a lower tax bracket than I think I will be in the future, right? So I rather pay my tax now than to pay my taxes later on. Because you got to think about it. Right now you're in your 20s and you may be in your 30s. You may have a kid or two. You may be married. Maybe your spouse may work. Maybe she may not work or whatnot. But the thing is, when you turn 60 and it's time to pay money, or 59 and a half, and it's time to pay taxes, now your kids are grown out the house. When you're in your 20s and your 30s, you have a family of 4. You fall into a different tax bracket. Now, you're 59 and a half. Maybe you may be a single man, or just you and your wife. You fall into another tax bracket, depending on what taxes are in the future. But one thing I look at taxes, I'll always suggest they're probably going to go up. Yes, don't borrow from your 401k for more debt. The only time I would say it's a smart idea, or maybe a good idea, to borrow from your 401k is if it's to pay off debt. And what I mean by that, let's say if you have a 401k, right? You have 20, 30, 40, 50, 60, $100,000 in a 401k. But you owe $20,000 on a credit card. That $20,000 on a credit card that you owe is moving at 15%. Let's say if you got a 15% interest rate. Now you may want to look at borrowing from your 401k, paying off your debt, paying off that 15% interest rate, and now paying yourself back at maybe a low interest rate of 1 to 2%, depending on the interest rate you have to pay to get back, right? Because you're not going to get anywhere with your 401k moving at, let's say your 401k is moving at 10 or 15 or 20%. Last year, the stock market went up 20%. But if you got a credit card that's 15 or 20%, you're spinning wheels. You're back to square one. So it may be sit down with a certified financial planner and then sit back and say, hey, you know what? Your credit card is charging you 15%. You can borrow from your 401k, pay off your credit card. Instead of paying your financial institution 15 to 20%, you could be paying yourself back at 2%, right? See how that makes sense? So now you can pay yourself back at 2%, invest and be able to catch yourself back up for in the future. And when you pay off that debt, your credit score is going to go up, right? When you pay off that big, large sum of debt, that credit score is going to go up. Instead of paying interest rates, interest rates and premiums and things like that on your credit card, you can now focus that money onto your 401k or into building yourself an emergency savings account, then going into your 401k. But if you have debt and you contribute to your 401k, sit down and evaluate your picture, because when you are putting money into your 401k and paying off your debt, it may behoove you to slow down or dramatically lessen what you're putting in your 401k to get rid of that debt, right? Because I don't want to go through the math and tell you how much debt will cost you over time. We all know it's a lot. It's not going to work in your favors. That's why financial institutions are getting richer and richer and richer. And I want to, since I'm here on the live and the podcast, or whoever may catch this around the globe, it was a classic mistake that I made with credit cards, right? When you get the credit cards, you get those rewards, right? I got it to build credit. So I'm very great with a credit card. But you get so many rewards. So the reason why they're giving you rewards is they want to, they spend millions and billions of dollars every year, credit card companies, to market towards you. They're doing research and development. They're trying to get you used to using the card, get you used to pulling out that card and paying back and get you used to it. In the beginning, you're good at it. Then, boom, you have a little situation. You're so used to it's playing upon your psyche, even if you're good at finances, right? Even if you're pretty good at finances, want to get you into the benefit of using a card. And the quickest way to get rid of credit card debt is to stop using it, negotiate, pay it down. That's the way to do it. That's the number one way that cripples us from building from our financial future. And you got to get in that notion of if I can't pay for it cash, I just don't need it, right? And I already understand how a lot of you guys probably out there think, man, yeah, I owe $1, $2, $3, $4, $5, $10, $12,000 on a credit card, but I'm gonna put it into this investment and it's just gonna flip, and it's gonna be so great. I'm gonna throw it into this whatever, I'm gonna buy some call options, some penny stocks, some forex, some cryptocurrency, and I'm gonna make $100,000 and I'm gonna be able to pay everything off. But 95% of people will lose, and it will only worsen your situation. Right now, you done lost the money that you could have paid off your stuff with. You done lost that, and you still owe the debt. So be smart. What changed me, one of the biggest things what changed me as a reading books and learning things, I learned that statistics are very important. Statistics are very important. You got to look at the statistic. If something is not in your favor, like look at the greatest investors of all time, like Warren Buffett, the Ray Dalios, the John Bogan, you have to look at what are the statistics of me winning and what are the statistics of me losing. And if the statistics are stacked high against you, you are playing a loser's game. And you won't be tuning in today or watching the playback if you was a loser. Nobody is here to be a loser, right? So get on the winning side. Get on the side where the statistics are in your favor of you winning, right? You pay off your debt. There's no risk with that, and it's that fear of missing out that gets us. But I don't want to get onto the soapbox here. But this is my Saturday or Sunday Prince Talk on the weekend, which I try to keep coming to you guys each and every weekend. But those are 7 tips. Look at those 7 tips. If you're someone who's looking to invest or I'm trying to invest or whatever, if you follow that should give you a good picture of how to start investing. I'll probably do another video maybe next week or something like that to talk about what in particular things you should look into investing in. Because I always tell you, it's not what you know that gets you in trouble. It's what you don't know that gets you in trouble. That's my greatest fear. My greatest fear is what I don't know, right? It's how many of us could sit back and look back and say, man, if I'd have known this, I would have just done this. I know I can. And if you can't do that, it's because you probably haven't learned enough. If you can't look at your old self and laugh, or look at things you've done in the past and laugh, that means you probably haven't grown, right? So, yeah, definitely stay tuned. But thank you guys for tuning in. You guys stay tuned. We got May 5th. I'm going to be headed out to Omaha, Nebraska to Warren Buffett's annual meeting. Where's my stuff at? Y'all hold on one second. Here it is. Straight from the man himself. From Berkshire Hathaway. If y'all guys can see that. See that? Straight from Berkshire Hathaway. Straight to me. Mr. Prince Dykes. So these are my passes to go back to see Warren Buffett. So I will be there. I'm seeing Warren Buffett here in about 2 weeks. And I'll be giving you guys exclusive straight talk. Hopefully I get to land some cool interviews and to talk to some people. And one of the biggest topics I think I hit up this year is probably the cryptocurrencies, right? That was a hot topic in 2017. It was the asset class that took over. So I want to see what some of the best investors in the world got to say about cryptocurrencies. We're going to sit back and have some good conversations. I'm going to document my time there, do another documentary. If you guys haven't seen my 2017 Berkshire annual meeting documentary, go back and check it out. It's right here on the channel somewhere. I don't have the link, but type it in there, Berkshire Prince Dykes, the Investor Show. You'll see it. But anyway, if you guys ain't got any questions, I'm about to get out of here. I got to go freshen up for bed, read over some things, and get ready to get back at it again. So until the next video podcast, don't forget to share this around. Tell all your friends. all the other great stuff. Until the next video podcast or whatever you see me do crazy around the globe. Peace. Be safe. I'm out. Thank you.